So the solution to the problem of unaffordable housing seems so simple, right? Just build more houses. Well, we have been. New construction is approaching the highest rate it has ever been since the 2008 crash. And that's despite record high construction costs that came about because of disrupted supply chains. The problem has been if we were building the right kind of housing. As costs rose and margin shrank, the only kind of property that remained profitable to build was luxury property. And now we have found ourselves in a strange situation. We might have too many houses. Now, I know what you're thinking. Sounds great, right? Wrong. Despite all of this new development, we are still short about 4 million homes by most estimates. And if developers can't sell the luxury homes they have already built, it's much less likely we will build the other homes we actually need.
Landlords could be left holding the bag, and renters, unless something really big happens, could go homeless.
These landlords are on the verge of bankruptcy of these apartment buildings behind me and across America.
This is what $218 million buys you in Palm Beach, Florida.
The luxury rental market is crashing.
Half of all renters in the U.S. are paying more in rent than they should.
Sold anything that I've had that's worth selling to try to make ends meet.
So there's actually a bit more to the numbers of new homes we are building. But what is clear is that in America in particular, we have been building way more apartments. 2 years ago, we actually broke the all-time record for the total number of new apartments built within a year, a record that has been held since the 1970s. That last spike was caused by demand from baby boomers entering the housing market for the first time. They wanted cheaper places closer to city centers instead of the Levittown-style suburbia they were raised in. These new apartments were pretty good. They were mostly well-built with relatively large floor plans that could easily accommodate larger families. This was helped by government-subsidized housing programs that meant developers could always rely on someone to sell or rent to. Largely, though, it was simply supply increasing to meet demand. This building boom eventually collapsed because of the recession of 1973. The oil crisis, the end of Bretton Woods, and new international competition all took turns beating on the US economy, making it more expensive to build for people with less money to buy new apartments. By the time the market had recovered, the baby boomers had largely lost interest in apartments and were moving back into the suburbs, only this time with much bigger houses. Potential spoiler alert, but at that time, we didn't realize we were in a recession until the end of 1974. New property construction has consistently been more in tune with the economy than the economists. So anyway, the most recent construction boom was fueled by a lot of things. New construction had recovered after the 2008 crash, and people were once again interested in living in apartments. According to a report by the Harris Poll, dual-income no-kids, or DINK households, have become the fastest group of homebuyers in America. Both people working makes low-maintenance apartments ideal, and the lack of kids means there is less need for extra space that typically comes with a single-family freestanding home. DINK households also have more spending power on average, so accommodating them with new property developments became very profitable. Young cashed-up renters or buyers were more likely to pay a premium for expensive-looking fittings, fixtures, materials, designs, and amenities in their apartment. Builders loved this, because a faux marble waterfall countertop and a few treadmills tucked into a corner room somewhere were very cheap to include in a build, but properties could then be sold at a much higher markup than typical budget-friendly housing, even if the apartments themselves were exactly the same size. Interest rates were also very low. Builders usually take out construction loans to finance the land purchase and the actual building of the structure. Once this is complete, there are various options for developers to get their money back, but the interest rate during construction is extremely important. For a little while, new apartment construction started to stagnate as interest rates were raised around 2016, but then everything changed when the COVID-19 attacked. Immediately following global lockdowns, starting new construction was very difficult, but quickly a few extra factors made apartments a hot commodity. People took remote work opportunities to move to different cities at a record rate. Add in stimulus, low interest rates, booming asset markets, and young adults who didn't feel like being stuck inside with their parents 24 hours a day, and it was the perfect storm for developers to make some money. New luxury apartment buildings sprung up across the country, often accompanied by flashy marketing campaigns to attract renters and buyers. The biggest factor of all, though, was that the developers didn't need to hold on to these buildings. Once constructed and rented out, the whole building could be packaged up and sold to a financial institution that would put them into a residential real estate investment trust, which would then be sold onto other investors who wanted exposure to a broad portfolio of real estate without actually having to manage the real estate directly. These REITs are not new, but they have grown in popularity, especially for residential real estate. This worked well to encourage building, but you might have already noticed that it sounds very familiar. For the builders and lenders, once heads were in beds, they didn't really care what happened to the building because it wasn't their asset anymore. Unsurprisingly, a lot of this new luxury housing turned out to be not so luxurious after all, and that was really the least of its problems. Millions of jobs, from architects to plumbers, rely on building these homes. Financial institutions have invested heavily into them, and even beyond the finances, this is all very dependent on these buildings not falling apart within the next 20 years. So it's time to learn how money works to find out how the real estate market drowned itself in the worst kind of oversupply. This week's video is brought to you by Brilliant. Brilliant is an interactive learning app designed to help you truly understand complex topics in math, data science, programming, and even AI. Instead of passive learning, Brilliant's lessons are all about getting hands-on and solving real problems, making learning 6 times more effective than just watching videos. Each course is built by experts from top institutions like MIT and Google, so you know you're learning from the best. Their data science courses, for instance, use real-world datasets from platforms like Airbnb and Spotify, giving you practical insights while you learn. I took Brilliant's logic course, and it walks you through a range of classic logic puzzles, from figuring out who's lying or telling the truth based on limited clues to solving problems with rules-based robotics and symbolic logic. It's a mix of brain teasers and formal reasoning that gradually builds up your logic thinking skills. Brilliant's also perfect for fitting into your day, whether you're on your computer or just have a few minutes with your phone. Try everything Brilliant has to offer for free for 30 days by visiting brilliant.org/howmanyworks. And if you like it, you'll also get 20% off an annual premium subscription. Okay, so clearly a lot of this luxury housing is not actually luxury housing. It's just expensive housing with a bit of a marketing budget. Those aren't always the same thing. Extremely large but poorly designed and cheaply built homes are not a new feature in most suburbs around the world, especially here in America. McMansions, as they are affectionately known, appeal to a market of buyers who don't have an endless budget but still want a house with a 4-car garage, a billiards room, 2 guest bedrooms, and an extra formal living room that never gets used. The solution was houses with a lot of square footage but very low cost per square foot. This normally means sacrifices are made in materials, insulation, and build quality. Long term, that makes these homes very expensive to maintain, but the upfront cost for the space you are getting is almost unbeatable. Or at least, it was unbeatable until supply chain disruptions made building materials extremely expensive. No matter how many corners are cut, bigger homes are just going to take more materials. According to the National Association of Home Builders, the average price of a new home in 2024 was $428,000, which means in most areas, it's simply not financially viable to build a new home, since an established house plus the land it's sitting on could be purchased for just as much. That has meant that the new wave of luxury housing development has mostly been in the form of apartment buildings, which have effectively just become McMansions in the sky. At the extreme high end, there are developments like 432 Park Avenue, 157, the Shore Club, and Central Park Tower. These high-rises, mainly along Billionaires Row in Manhattan, have sold individual apartments for hundreds of millions of dollars to people like Michael Dell, Ken Griffin, and everybody's second favorite Twitter shitposter, Bill Ackman. Below that, there are a new wave of premium developments with accommodations ranging from $1.5 to $10 million in most large cities across the country. Households in the top 10% of incomes already account for half of all consumption in America, and they are willing to pay a lucrative premium for new upmarket housing. Then, there's the largest group of these new developments, which are pretty much just investor stock apartments with nice-sounding names like the Concord or the Bayview. These are primarily mid-rise or 5/1 style developments, made to a budget for the express intention of being a financial asset with the added side effect of giving some people a place to live. Thanks to a change in building codes around fireproof construction following the 2008 crash, 5/1 developments became much easier to build. This bottom floor is typically dedicated to retail spaces, and then atop that, there are 4 to 5 stories of wood frame construction for apartments. These buildings per square meter are some of the cheapest structures to build, and have become the most profitable to develop because they were possible to sell or rent at a significant markup over their building costs, and then they made the perfect risk-reward asset to put in the portfolio of institutions that have purchased thousands of these multifamily dwellings. Additionally, the retail space below gives a secondary rental income stream that is not directly correlated with the residential market. Now, hot take alert, but yes, these buildings often do look very ugly. But at a time when we are desperate for more housing, we might not have the luxury of being too picky about aesthetics. However, there are 2 other problems that are far more serious than some gaudy facades. The first problem is that the people constructing the buildings are a long way removed from the people who will eventually own them. A developer will normally subcontract a builder who will subcontract tradesmen who will actually do the construction. The developer will either then sell the building to individual apartment owners, or more likely, they will sell it to a firm that aggregates these buildings before selling them as a portfolio to an investment fund, which will further bundle them up to sell them as a residential real estate investment fund, which will be sold to retirement funds, which will be sold to you. That is assuming you have retirement savings. Now, the financialization of the real estate market never hurt anybody before, right? But it does mean that building standards have consistently been lacking because all of the groups involved just want to build to a set budget before passing the hot potato of responsibility along to the next person. This has happened across all of these tiers of luxury housing. Even ultra-luxury developments like the Trash Can Tower at 432 Park Avenue are riddled with structural issues leading to lengthy lawsuits just to figure out who is ultimately responsible for fixing the problems. Now, obviously, in a building where the average apartment sold for more than $10 million, the residents will have the time and resources to take a property developer to court. But a lot of other less high-profile property buyers don't have that luxury if their hastily constructed home falls apart. The second problem with these new developments is something that affects you even if you never buy, build, or invest in these properties. Higher density housing needs higher density services to deal with traffic, waste management, schools, and emergency services. These have to be supplied by the municipality, not the developer, and property dues on these units are normally much lower than freestanding single-family homes. To be clear, mid to high-density housing is much more fiscally manageable than suburban sprawls, which requires proportionally more roads and connecting services. But the boom in new apartments are still a significant short-term expense that has to be accounted for even if they are cheaper in the long term. But then there's the biggest problem of all with this new luxury living space. Nobody wants to live in it. Because of the luxury branding, many of these new units are more expensive than homes that are much larger. This is especially the case for larger apartments with enough bedrooms for families with children. A 4-bedroom home is a pretty typical staple of most American suburbs. A 4-bedroom apartment is a penthouse that commands an ultra-luxury premium. If you enjoy a good doom scroll on Zillow, try and find a 4-bedroom apartment in your city or town that costs less than the average 4-bedroom home. As new buildings are finished, they are further saturating a market that has done too much too quickly. In certain cities, developers are now offering multiple months of free rent, or concessions like holidays or jewelry for people who sign year-long leases in their new buildings. Now, you have probably already asked the logical question, which is that if nobody is renting these places unless they are given freebies, why don't they just make the rent cheaper instead? Well, they can't. Yes, according to some rigorous calculations, $2,000 a month in rent for a year with 3 months free is the same as just charging $1,500 a month. But the number crunchers don't see it this way. Most of these buildings will be sold based on a multiple of how much income they are generating, something known as the capitalization rate, or cap rate. In non-financial jargon, this is what percent of the purchase price a building returns in income every year. So a $10 million building returning $500,000 a year in income would have a cap rate of 5%. Or, put another way, if investors are willing to accept a 5% cap rate, which is generally where the market has been heading, then a building returning $500,000 a year is worth $10 million. But if those apartments are rented out at a higher base rate and are returning $600,000 a year, then the building is worth an extra $2 million. It looks much better on paper to have an apartment rented out for $2,000 because that can be multiplied by 15 or 25 to give an appropriate sales price. And then the valuers don't need to know about the special deals made earlier in the lease. Now, the institutions buying these multi-million-dollar properties aren't stupid. They know this is happening, but they don't really care because they know that once people have moved into a home, they don't typically want to leave if they can avoid it. According to NerdWallet, the average cost to move houses is more than $1,700. And on top of that, it's a major pain in the ass. Even if people do move out because their rent gets too expensive, that doesn't really matter, because by the time that happens, the building would have been securitized and sold onto some faceless REIT investor. Now, there is one other reason why the whole industry is desperate to make these numbers look as good as possible as quickly as possible. A lot of these new constructions were financed back when rates were very cheap, and most construction loans only last between 3 and 5 years before they need to be refinanced. Unless they start generating an income, these buildings will be very hard to refinance, meaning that a lot of highly leveraged developers could find themselves in a very dangerous situation. The most disappointing about this whole trend is that medium density housing is desperately needed in America. It's probably the best way to address the problems of endless urban sprawl, car dependence, and unaffordable housing. Unfortunately, we have implemented a good idea in the dumbest way possible. Now, if you are thinking this all sounds like a golden opportunity to finally build up some affordable real estate, go and watch this video next to find out why a real estate crash probably won't help you afford a home. And make sure to like and subscribe to keep on learning how money works.